To the Minda Limited Q4FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Now I hand over the conference to Mr. Sunil Bora, Group CFO. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and a warm welcome to all the participants. On the earnings call today, I am joined by my colleague Ankur Modi. We have uploaded our financial results and investor presentation for Q4FY23 on the stock exchanges and our company's website. We hope everybody had an opportunity to go through the same. I will first start with the industry updates and overview, followed by our financial and operational performance for Q4 and FY23. Post that, we will open the floor for Q&A. India remains one of the fastest growing economy in the world, despite decelerating global demand and tightening of monetary policy to control inflation. India stands strong and steadfast, emerging as a beacon of resilience in the global economy. The overall growth is estimated to be 6.9% for full year, with real GDP growing 7.7% year-on-year during the first 3 quarters of fiscal year 22-23. Growth was underpinned by strong investment activity, bolstered by the government's capex push and buoyant private consumption, particularly among high-income earners. Inflation remained high, averaging around 6.7% in FY22-23, wherein recently the WPI has went into negative with higher base effect. This should lead to continuation of the pause in interest rate hikes. The current account deficit narrowed in Q3 on back of strong growth in service exports and easing global commodity prices. Speaking about auto industry, the automobile production achieved robust growth of 13% in FY23, with growth witnessed across all vehicle categories. Passenger car segment achieved highest ever production, crossing 4.5 million for the first time. The steep growth was a function of series of new model launches and better product availability due to the easing of supply chain. The demand for high-end variants and premium SUVs remained robust. After 3 consecutive fiscal years of headwinds, two-wheeler category also recorded growth of 10%. However, production volumes are still significantly lower than pre-pandemic levels. There is a weakness at the lower end of the market, as visible from sale of smaller cars and entry-level two-wheelers. The industry grew despite rising interest rates and inflation reducing disposable earnings. Commercial vehicle category 2 registered healthy growth of 29% in FY23 and is close to the previous peak of 18-19, supported by a healthy pickup in macroeconomic activity. Over the quarter ending March 23, EVs and CVs grew by 13 and 6% respectively, whereas two-wheeler declined marginally by 2%. During FY23, the electric vehicle market in India has also delivered significant growth, with a rapid increase in sales of LCV, two-wheeler and three-wheeler electric vehicles. Resultantly, the Indian electric vehicle sales crossed 1 million units for the first time in FY23. As per Society of Manufacturers of Electric Vehicles, in the electric two-wheeler segment, the industry sold 7.26 lakhs high-speed e-two-wheeler in FY23 in comparison to 2.52 lakh units in FY22. EV penetration in this category during the year was at 4.5%. EV two-wheeler sales for the quarter was around 2.16 lakhs, representing overall penetration of around 5.4%. Penetration levels have been gradually increasing quarter-on-quarter basis. Going forward, we expect growth momentum in the automobile industry to continue into FY24 and will be poised for reasonable growth owing to strong demand especially in passenger cars and easing supply chain issues. Two initiatives announced.
On the web for especially in passenger cars.
Sorry, apologies for this. Few initiatives announced in the budget will also positively affect the passenger vehicle sector growth in FY24. However, an increase in cost of ownership remains near-term headwinds for the industry. The long-term prospects for the auto industry remain highly optimistic. India embraced the challenges faced in the past few years, and now it is at the cusp of rapid growth over the next decade. Indian consumer approach and behavior is changing considerably towards mobility. Considering the growth prospects, some of our customers have also announced large capacity expansions. This augurs well for the entire auto industry. With PACE, which is personalization, autonomous, connected, and electrification as core of its existing and future product roadmap, we are well placed to capture growth opportunities in the sector. We are focused to solidify and increase our market share by providing high-quality, innovative products and securing new business in both ICE and EV segments. The specific highlights for the quarter and FY23, you can refer to slide number 5. The company has completed acquisition of its remaining stake in Minda Aluminium, making it a wholly owned subsidiary. The board has also approved merger of MKA and other two Kosei joint venture entities, which are Kosei Minda Aluminium and Kosei Minda Mold. The company has commissioned 30K expansion line in Gujarat, expanding its capacity from 2.9 lakh wheels per month to 3.25 lakh wheels per month. Another 45,000 wheels per month capacity has been added from KMA through consolidation of Kosei Minda. We continue to build strong order book for four-wheel lighting, alloy wheel business, as well as for EV-specific products. Coming to financial and operational performance, you can refer to slide number 7 and 8. At consolidated level, revenue from operation for the quarter increased by 20% year-on-year to 2,889 crores from rupees 2,415 crores in Q4 of FY22, as we continue to gain market share and increase kit value. We have witnessed growth amongst all our products led by EV products, lighting, PV alloy wheels, etc. The consolidated revenue largely remains even on quarter-on-quarter basis, as increase in passenger vehicle volumes are offset by decline in two-wheeler volumes and reduction in commodity prices being passed on to the customer. EBITDA for the quarter was at 319 crores, improving by 16% from 276 crores year-on-year basis. EBITDA margins for the current quarter, though marginally down at 11.1% against 11.4% in the corresponding quarter last year, which is as per our guidance. Finance costs have increased to 21 crore in comparison to corresponding quarter last year on account of incremental borrowing for capex and working capital and certain investments. Borrowing costs have also gone up following series of hikes by RBI, which is being passed on by the bank in a staggered manner. Our effective tax rate has decreased from 30% in last financial year to around 24% in FY23 on account of movement to the new tax regime in the current financial year and reversal of around 6 crore of tax provisions no longer required post favorable closure of certain tax assessments. The profit after tax, which is Uno Minda's share for the quarter, was at 183 crores as against 144 crores in Q4, reporting a growth of 27%. We would like to highlight that PAT for the quarter is highest ever quarterly PAT reported by the company. On a full year basis, the company has demonstrated excellent performance with 35% growth in annual revenues to 11,236 crore in FY23 as against 8,313 crore in FY22. While industry volumes have grown by 13%, we continued our outperformance by registering growth at 35%. EBITDA for the same period in FY23 is 1,242 crores in comparison to 885 crores in FY22. Talking about margins, the EBITDA margins were higher at 11.1% in FY23 as against 10.7% in FY22 due to benefits of operating leverage partially offset by higher material costs. We would like to inform you that company has achieved pre-tax ROCE of 19.2% on FY23 a significant improvement from previous financial years. Dividend. The board has also recommended the final dividend of 1 per share, which is 50% of the face value, reflecting commitment from the company to return value to shareholders on a consistent basis. The company had also paid interim dividend of 0.5 per share in February 22, making total dividend of 1.5 per share for FY23, translating into dividend payout ratio of 13.2%. Coming to the business segment-wise performance and moving to product lines, starting with switching systems, you may refer to slide number 13. The segment achieved revenues of 835 crores for Q4 and 3,203 crores for full financial 23, contributing 28.5% of our consolidated revenues. Increasing features like infotainment, sunroof, power windows, overhead console, etc., led to increase in number of switches in PV, continue to drive the business growth along with increasing SOB with Indian and Korean customers. During the quarter, we received incremental orders from Korean customers, further strengthening the relationship. In two-wheeler switch business, we have started export of heated grip and can-based switches. Our expansion of four-wheeler switch plants at Chennai and Faruknagar, Gurugram are going as per the plan and is expected to commence operations in Q2 of FY24 and Q3 of FY24 respectively. Moving to lighting business, it has achieved a revenue of 673 crores for Q4 FY23 and rupees 2,575 crores for full year FY23, contributing to around 23% of our consolidated revenues. We have received incremental orders of more than 300 crores in four-wheeler lighting business from Indian and Japanese OEMs. We have been working on various innovative lighting products and are accredited with various firsts in the business. We recently launched cornering lamps for one of the two-wheeler OEM and connected lamp for a Japanese four-wheeler OEM. Four-wheeler lighting Gujarat plant has been commissioned and is ramping up from current quarter with SOP of underlying model in last week of March 23. Besides, we have completed land acquisition for our new lighting plant announced in November 22. The plant will be set up in Khed City, Pune. We have acquired 86 acres of land in Khed City for lighting plant as well as for future requirements. The above acquisition also marks a shift in the company's strategy from buying pocket of land as per exact requirement to buying a large plot of land to meet current as well as future requirement. The revised strategy will serve dual purpose. First, it will expedite future extension as it will eliminate any delay on account of land acquisition. Secondly, we can build bigger plants and consolidate our existing plants to be able to better manage our operations and achieve economies of scale. Moving to our casting business, it has achieved revenue of 538 crores for Q4 and rupees 2,175 crores for full financial year 23, contributing to 19% of our consolidated revenues. During the quarter, we started commercial production of 30K line in Gujarat plant and is expected to stabilize in Q1 FY24. Four-wheel alloy wheel capacity at Gujarat now stands at 1.2 lakh wheels per month of GDC technology and 25,000 wheels of LPDC technology. With respect to capacity expansion of 60K at Bawal, the land acquisition is in process. Post-acquisition, the construction activities will commence. In two-wheeler alloy wheel business, we have started supplies to fifth customer. The ongoing expansion of two-wheeler alloy wheel plant at Supa is expected to commence operation in a phased manner by Q3 FY24. In aluminum die casting business, we have started supplies to a PV OEM and a two-wheeler EV OEM. Moving to acoustics, slide number 14. Our acoustics business had achieved revenues of rupees 196 crores for Q4 FY24 and 736 crores for full financial year FY23, contributing 7% of our consolidated revenues. While India business remains stable, European subsidiary Clarton Horn made decent recovery supported with price increases from some of its customers. Moving to our seating business, we achieved revenues of 263 crores for Q4 FY24 and rupees 1,053 crores for full financial year F23, contributing 9% of our consolidated revenues. The seating business achieved highest exports of rupees 200 crores in FY23. Exports is expected to be one of the key drivers of growth of the business. Seating business is poised for healthy growth with SOP of at least 3 new two-wheeler EV OEMs in next 6 months. Moving to other product businesses, we have achieved revenue of 384 crores for Q4 FY23 and 1494 crores for full financial year, contributing 13% of overall top line. Other businesses mainly comprise of controllers, sensors, ADAS, blow molding business, battery and aftermarket. Blow molding business, sensors, controllers, EV systems continue to grow. The share of profit loss of associates joint ventures for Q4 is at 24 crore as against 29 crore in Q4 FY22. While all our JV associates contributed positively, major contribution came from Denso 10, Doki and TV. Moving to EV sales, the revenues from EV two-wheeler OEMs increased to 78 crore in Q4 FY24 as against 67 crore in the last quarter. EV two-wheeler OEM revenues as percentage of our two-wheeler domestic revenues stands at around 8% for Q4 FY24 as against two-wheeler EV penetration of around 5%. The revenues from EV two-wheeler OEM has been steadily increasing. Given our formidable EV specific portfolio and potential kit value, we have outperformed the EV two-wheeler industry as well. Our JV with Trivo EV Systems, which is currently operating from a temporary facility at Manesar, would move to its new plant at Farrukhnagar by Q2 FY24. Uno Minda Buller is also expected to commence operations from its new plant by Q2 FY24. Commencement of these plants should give further boost to our EV two-wheeler OEM revenue. We are pleased to inform you that we have completed the development of Soundbox, which is the artificial sound maker for EV two-wheeler during the quarter, and have also started supplies of the same. We have announced multiple order wins from EV OEMs in last few quarters, and we continue to receive further orders. Total annual peak revenues from these orders stand at rupees 1,900 crores, out of which orders from two-wheeler EV OEM comprise of 1,340 crores, and for two-wheeler EV specific products, rupees 700 crores. We have also won order from PV CV OEMs of around 550 crore, including order for EV specific products from an LCV OEM. Moving to aftermarket and industrial revenues, you can refer to slide number 14. In terms of our revenue pie for the quarter ended March 31, 2023, OEM business accounted for 89% and aftermarket business at around 11%. Our aftermarket division revenues were at 281 crore as against 225 crores in corresponding quarter last year. Aftermarket revenues have grown 25% year-on-year basis. Our aftermarket division for the first time has crossed 1,000 crore mark and achieved revenues of 1,042 crores for full year. We are successfully running various B2C marketing campaigns for our aftermarket division. Moving to our cash flows and debt levels, our net debt as of March 31 was at 1,078 crores compared with 556 crore as of March 31, 2022. Our net debt to equity stands at 0.24. While the funding requirements towards capital expenditure, both growth and sustaining capex, high working capital requirement of 284 crores, consequent to 35% growth in group revenues, were all met by internal cash generation. Net debt has increased primarily on account of investment of around 125 crore in Trivo, Germany, investment in TRMN plus some new joint ventures of around 40 odd crores, acquisition of minority stake in Minda Kosei for 115 crores, and advance of 70 crores for acquisition of land in Pune for existing and future projects. The consolidated financials also include debt of rupees 60 crore and net fixed assets of 75 crore of KMM and KMA, is Kosei Minda Mold and Kosei Minda Aluminium, wherein the financials getting consolidated pursuant to taking management control. Capex also includes rupees 75 crores of assets of KMM and KMMA as explained a while back, advance of 70 crores for land in Pune, and certain lease assets capitalized as per Ind AS. Moving to strategic business update. First being Kosei entities restructuring. The company has completed the acquisition of remaining stake of 22.64% in Minda Kosei Aluminium, making it a wholly owned subsidiary. During the quarter, the board of the company has approved acquisition of 81.69% in Kosei Minda Aluminium Company Private Limited and 49.9% in Kosei Minda Mold Private Limited. from JV partner Kosei Japan. The acquisition is planned through composite scheme of merger with Minda through swap of shares. The scheme was filed with stock exchanges seeking for NOC. The proposed transaction is one more step towards gaining significant pie of this growing four-wheel lorry market, simplification of the group structure, and to facilitate achievement of economies of scale. While the merger will be subject to various statutory authorities, Minda has started managing the business and operation of these quantities with effect on 1st of April. Consequently, financials of KMM and KMA are getting consolidated line by line from 31st March 2023. While consolidation is reflecting in consolidated balance sheet as on 31st March 2023, with addition of assets and liabilities of both these companies, the P&L consolidation will come from subsequent quarters. The company has entered into TLA with Kosei Japan to ensure continuity of technical support. We would like to inform you that order for merger of two other schemes, which is Minda iConnect merger and Harita Ferrer plus battery business merger, the decision is reserved by NCLT for pronouncement. Moving to our kit value, you may refer to slide number 30 for potential kit value. During the year, we saw further expansion in our kit value across vehicle segments. In C segment of passenger vehicle, we achieved 43% increase in kit value owing to addition of connected tail lamp, recliners, HD camera. Besides, we have also added products of our joint venture entity TGSIL, which was not added to potential kit value till last year. In SUV segment, our potential kit value is at around whopping rupees 1.97 lakhs. Kit value in two-wheelers has also increased due to increasing application of sensors like side stand switch, speed sensor, acceleration position sensor, as well as due to different type of lamp like LED headlamps, blinkers, reflector, and cornering lamps, etc. Moving to ESG, the climate change is one of the greatest challenges of our time, and we as an organization are acutely cognizant of the role that we have to play in mitigating greenhouse gas emissions. Energy conservation and optimization is of the utmost importance to us. However, in addition to adopting various energy efficiency measures, we have significantly increased our uptake of renewable energy as key aspect of our decarbonization strategy. In the last 2 years, we have installed rooftop solar panels at 25 plants along with solar open access projects at 6 locations, increasing our renewable energy share at 18%. As a testament to our commitment to decarbonizing our operations, we have also set ourselves an ambitious target of meeting 40% of our energy needs from renewable energy by 2025. Moving to next year, as you know, while we do have our revenues linked to industry volumes based on the order book, we remain optimistic on our ability to outperform the industry growth. We will start production from multiple projects like new plant of EV JV with Privo, new plant of EV motors, 4-wheeler and 2-wheeler alloy wheel expansion, 4-wheeler switch expansion in Chennai, and ramp up from 4-wheeler lighting plant at Gujarat. This should significantly boost our revenues for next financial year. In terms of margin, we expect to maintain the EBITDA margin within the current range on an annual basis. Next year, based on the current approved projects, we expect to incur project capex of around 400 crores and sustaining capex of around 300 crores. Kindly note that this capex guidance doesn't include capex which may incur for building land bank as part of our strategy for future growth. With this, I would like to now open up the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Mumuksh Mandlesha from Anand Rathi. Please go ahead.
Thanks for the opportunity, sir, and congrats on yourself on the new role, sir.
Mumuksh, your voice is very feeble actually. Could not hear.
Can you hear me, sir, clearly now?
Yes.
Thanks for the opportunity, sir, and congrats, sir, on the new role, sir.
Thank you.
Sir, the capex for this year was higher than the guidance. This is mainly because land bank, sir?
So there are 2 key aspects, as I said, Mumuksh. One is definitely land bank. Then there is around 65-70 crore worth of assets which are added as part of consolidation, which were not there earlier, which is KMA and KMM, and also there are certain assets which you have to capitalize because of the leasing assets because of the Ind AS 116. So all this put together are more than 200 crores.
Got it. So can you talk more about the new EV order wins and also on the four-wheeler lighting? And can you update the progress in terms of order wins for the Buller JV for the motors, sir?
Yeah. So in terms of four-wheeler lighting, as we said, we have got around 15 crores of incremental orders this year. So if you see, since last 2 years, we have been consistently adding business, and today, as we speak, we have added more than 1,000 crore worth of new business for lighting four-wheelers, and that's why we are setting up this new plant in Pune to cater to a large part of those incremental business. In terms of EV, as I said, we have added significant new business from EV for both products which are existing products which are EV agnostic or products which are EV specific. So that's what will continue to sort of grow, and all these businesses, we know that we will start SOP gradually as the OEMs also start volumes and also replace some of the imports with the domestic ones. And in terms of the motor JV with Buller, we have already added 2 customers, as you said last time, and we are also engaging with few more customers. Hopefully, we should have some good outcome in next couple of quarters.
Right. So the order book which you mentioned will be excluding the Buller orders?
No, this is all including. These are all EV products, which includes the motor.
Okay. And so this quarter, the gross margin was lower sequentially. Any reasons for those, sir?
Yeah, so gross margin is low, and you are right, primarily because of there are 2-3 businesses where we had what you call the higher RMC, which are the new ones relatively, like there has been some impact in two-wheeler alloy wheel, where the price increases, etc., we have got in Q3 itself. So obviously you don't have that advantage of getting the arrears. So normally what happens is that in Q4 you tend to get a lot of PIs closed, but this time we have got good PI closure in Q3, and also in Q4 there has been softening of the commodity, so you don't see that kind of PI benefit from the customers, and that impacts the gross margins.
Got it, sir. Thanks for the opportunity, sir.
Thank you very much.
Thank you. We have our next question from the line of Siddhartha Bera from Nomura. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, first question on the revenue side, like you said, we have won a few orders from Korean customers in switches, and in the past also in the lights and alloy wheels, we have continued to win orders. So if you can broadly highlight in our revenues, how much will be Korean players in terms of mix, and in terms of the order book, how does it look? And if you have the share of business as well, that will be very helpful.
Oh, thanks. So in terms of the switch business, we have added roughly around incremental 30 crore of new business for the new upcoming model from the Korean customer. In terms of alloy wheel, you know that we have set up only 25,000 wheels capacity, which is the LPDC capacity which we are supplying to the Korean customers, and we are currently not have expanded our capacity. So until then, we are limited by the capacity constraints, because LPDC is a technology which is what the Koreans sort of apply in their vehicles. Lighting, I don't know. Lighting, normally, we have not yet been able to penetrate into the Korean customers, honestly speaking. And the last point was in terms of the order book. So we are not actually separately capturing or the order book as customer-wise. So what we do is we do calculate our market share product-wise, but the order book normally customer-wise we will get only when we see the business by business. So we don't normally see at a group level, but it's a good point. Maybe from next time on, we'll start capturing that data to that.
Got it. So second question again on the revenue side. I mean, this quarter on the casting side, despite like PV industry volumes going up, we have not seen quarter-on-quarter increase. So is it limited the capacity, or why it is sort of flat quarter on quarter? And second, again, on the others, we have seen some dip quarter on quarter. So if you can just highlight the reasons for this.
Yeah. So very good point, Siddharth. So on the casting business, there are two reasons, and I am trying to be fully honest. First, there has been softening of commodity prices. So that is passed on to the customers immediately. So that has an impact in terms of the revenue. Second, because of this OBD2 norms kicking in on 1st of April, the two-wheeler volumes in the Q4, there we have seen some unplanned drop, and that's why we had to maybe limit some of our production, which has impacted our casting revenues. So I think these are the two key reasons why you see the casting business overall lower than what you have seen in the previous quarter. And in terms of others, let's see, mainly battery, if I remember. Yeah. So mainly it was aftermarket batteries which goes into that other segment.
Okay. So last question on the margin side, again on the gross margins, these are quite low levels if you look at the last couple of years trend. So, I mean, should we expect some normalization as your other businesses ramp up, or do you believe, it might, these are more sustainable levels? Can you just help us understand that?
Yeah. So, Siddharth, in terms of margins, you know that this quarter we have commissioned two new plants where you start with your OPEX, but you don't have much of the revenues. So that has an impact little bit. And second is in terms of the PI, as I shared little while back to Mumuksh, in terms of normally in Q3, Q4, you do get a good PI which is actually retrospective. Because normally it takes time. You file a claim in Q1, then you have discussion in Q2 and start getting Q3, Q4. This time we have got some good, closure of such PI in Q3. And Q4, there has been some softening of the commodities. Obviously, you can't have any price increase, and there was some offset. Obviously, customer would force you to do that, right? So I think these are the three key reasons. But yes, we note your point, and we are working on this to see that we improve it in terms of overall gross margin as we move forward.
Thanks a lot, sir. I'll come back in the queue.
Thank you, Siddharth.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone. We have our next question from the line of Aditya Jhawar from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is on Harita. So, sir, if you can highlight that, how has been the progress in winning orders from the Indian OEM? The thought process we had that after acquisition, we will diversify our geographic footprint and try to engage with more OEMs where TVS did not have a relationship with. It's encouraging to see where we are doing, we are doing extremely well in export. But on the domestic front, if you can throw some light.
Yeah. So that's a very good question, Aditya. And I think it's a miss from my side also, which should have captured in the presentation. So we have actually added one more two-wheeler OEM in our two-wheeler seating business, which will start SOP somewhere from the next quarter. So which earlier, obviously, being part of OEM, they were not able to do. So we have got a big success in terms of addition of domestic OEM two-wheeler category. And you know that post-acquisition, we have added some of the four-wheeler customers also and some TV customers also post the Minda acquisition. So that value add from Minda is definitely happening, and we are very happy to say that we have actually added one more two-wheeler OEM, which is what we call a existing one, not a two-wheeler OE, but EV, but traditional two-wheeler OEM.
Okay, that's very good to hear. My second question is on the Korean OEM. So clearly now we are supplying LPDC products from Gujarat. Is there a line of sight that in the next 2 to 3 years the business will ramp up quite a bit, and there is a plan to set up a facility in Tamil Nadu, so that it's relatively better, and it's heartening to see that we have also penetrated in the switching. If you can throw some light on this.
Yeah. So in terms of LPDC, yes, we might have to expand the facilities, but whether it will be Tamil Nadu or existing, we have to see, because Aditya, you'll appreciate, once you open a new location, then you have the entire paraphernalia of the management systems, everything gets replicated, and you sort of have no advantage of operating leverage. In fact, you have negative, because initially you have a lot of fixed costs and where your revenue doesn't come in the first year. And then what we normally do is we weigh that against the logistics cost, as in terms of what customer looks at the landed price. So what is our landed price versus if you have to set up a plant in closer to the customer, or we expand the plant in the region where there are more customers, or we expand the existing plant. So all those aspects. But yes, the teams are working in terms of coming up with a project for increasing capacity for LPDC wheel. Yes, there is some discussions going on with the customers for more business, what we can secure. And once we have visibility of that business, you know that normally we would commit into capex only after that, because we don't want to have a scenario where we commit for capex and then sort of you are at a disadvantage when you have to secure a new business. So that's the strategy we are adopting, Aditya.
Okay, thanks a lot. And the next question is, sorry to go back on margin. So we understand that this quarter we did not get the price increase benefit that we typically get in Q4. But if you have to look at the historical trend, our gross margin trajectory has been, coming down. And if you can give us some sense that what is the function of the business mix change that is having an impact on this, and what should be our sustainable gross margin going ahead?
Yeah. So Aditya, the way this gross margin is, that some of the business has higher gross margins where you have higher other costs. Like for example, in casting, you will have higher gross margin, but there the operating costs or the conversion costs are very high because of the inherent nature of the business. And also the capex intensity in those businesses are higher. So in this quarter also that we have started these two new projects, which is the blow molding business in what we call Bangalore, the new plant, and also this lighting plant in Gujarat. There, obviously, initially you have higher RM cost, which impacts this, and also in terms of mix. Normally, as I said, the higher capex business like blow molding or casting will have higher gross margin because of the conversion costs of like electricity and also depreciation are higher versus what you see in the other businesses. Also, in the new lighting business which we are adding, the lighting, what we call the LED aspect, there structurally the gross margins are less, but the cost of what we call the conversion to FG is also less. Say for example, if you have, but in terms of EBITDA, it may not be very different. So give you an example, in terms of say lighting, halogen lamp also, right? There, if my gross margin say was around 30-35%, but in the LED segment, it may be only 20% because the cost to convert that from RM to the finished good, because in LED is a lot of electronic component, right? So you don't have that kind of conversion cost because the price itself goes 3x. So a halogen lamp to a LED lamp, we know the delta is almost 2.5 to 3x. In fact, some of the tail lamps are even much more. So there, your GRM is lower, but it compensates at the EBITDA level because the conversion cost from GRM to EBITDA is different. I hope I've been able to give you a little detailed answer, but it gives you a gist.
Absolutely. Thanks a lot for that. And the final question I have is that on capex, you mentioned that 400 crore total capex, out of that sustaining would be about 300 crore, but that doesn't include your land bank capex. So what could be the magnitude of this land bank capex, Sunil?
Yeah. So this first of all, this land which we have acquired in Khed, that totally was something around 160 odd crores. Of that, we have paid 70 crore in March as an advance, and balance was paid in April. So this 90 crore obviously has already been paid. We are also looking at another sort of a similar land bank in North, where we have, you know that our customer is consistently expanding. So obviously we would also need to expand for future growth. So strategically, we know that land is a scarce resource, and we have faced this challenge many places. In fact, you would have seen or noticed in one of our project which we have announced in November for the expansion of 60K alloy wheels in Bawal. There we are still not having land in our hand, and the customer SOP date is approaching very fast. So land has been a consistent challenge of late, and that's why we have been thinking, yes, it's an investment. It's a one-time investment which will get recovered maybe future, because future if you have to put up those projects, I'm sure you will imagine the land prices which are continues to go up and has a scarce commodity. It addresses two things. One, you have the land in hand, which gives confidence to the customer also in terms when he has to award you a business that yes, you will not waste any time for procuring land. B, land is an asset which continues to appreciate. So if not today, you have to anyway buy tomorrow when you have to set up a plant, right? So, and land being an inflationary sort of commodity and also scarce commodity, it makes sense to build a land bank. And most important thing, which is the third part, Aditya, is that when you talk of that scale, then you also have ability to go and negotiate better incentives with the government. So the project which we are setting up in Pune, we have got a very good incentive scheme from the government approved for our lighting plant. So there are multiple benefits. Yes, it has an immediate cash flow, but it more than offsets the benefits going into future.
Perfect. Okay, thanks for the detail. Just last question, if I can add, any update on this airbag capacity when it is coming on stream? Are you hearing about government, changing the timelines of airbag, mandatory airbag that is expected from October?
Yeah, so timeline I will refrain from commenting, Aditya, because it is in the government court, so no one can comment on. But based on what our customer says, we are gearing up, we are ramping up. We are setting up a new plant with 75 crore worth of investment adjacent to a plant in Nimrana, specifically for airbags. And this capacity will be up and running by middle of next year.
So middle of next year. Okay. So earlier you had planned in Q4. Now it's middle of next year.
Yeah. So Q4, the plant will be ready. I said up and running. So you will have that commissioning time, etc., etc. That's factoring that also.
Perfect. That's it from my side. All the best.
Thank you, Aditya.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi, sir. Sir, what was the revenue in the passenger vehicle alloy wheels and the two-wheel alloy wheels for the year?
So, four-wheeler alloy was somewhere around 350 crores, whereas two-wheeler alloy and casting was 100 crores each.
And for the full year?
Come again?
Full year for the 23 as a whole?
This is for the quarter, and for full year,
300 each roughly for casting and AWW.
So for AW, TW, it will be somewhere around 450 crores, and casting also somewhere around 400 crores, and whereas four-wheeler alloy would be somewhere around 1275 crores.
Okay. And this lighting order win that you mentioned, 300 crore, is the full year order win, right?
This is annual peak revenue, yes.
And this will go in the entire year in 23 basically as a whole.
Yeah. This is the annual peak revenue which will achieve.
No, I got it, but this order came in the 4 quarters, not only in the 4th quarter, I mean to say.
Fourth quarter.
This is in the
Only fourth quarter.
Only for the 4th quarter, yes. The additional that was in the 4th quarter.
Okay, so how much orders we have won in this financial year as a whole, like FY23 as a whole in lighting?
So overall, as I said, Ashutosh, for total order book for EV customers, two-wheeler EV only is around 1,340 crores.
Okay.
Of which EV specific products is 700.
Lighting, only lighting.
Four-wheeler lighting. So this would be, I think, in aggregate, we would have announced a lot of orders. Would be somewhere around 800 crores kind of plus orders. 1,000 crores. 800,000 crores of annual peak order value, which you would have received for four-wheeler lighting up till now.
Okay.
Increment.
In the last year, like this. Okay. Okay. And lastly, coming back again on the margin side, if you look at, like, you see the major compression in the EBITDA margin is coming in the standalone side. If you look at, probably we used to make around 10% kind of margin in standalone consistently. This quarter is only 8.4%. And mainly you have two-wheeler switches, lighting, and this two-wheeler alloy wheels business over there. So is the compression only coming from two-wheeler alloy wheels only, or even the switches and lighting business has some compression EBITDA margin in this quarter?
Yeah. So, Ashutosh, because we are going into little detail, so I can tell you that in two-wheeler, obviously there has been little bit of impact on the exports, though not that big, but obviously it adds because export has got a much better margin. Also in lighting four-wheeler, some of the service income or the tooling income which comes, we have because the model launch happened in Q3. We have been able to advance that income in some of that income in Q3 versus Q4. And AWW, as we just spoke, that volumes have been lower. So all these things put together definitely has impact on the standalone financials.
So that should normalize, like say, going ahead. The full year number probably is a right reflection of the margins. Is that correct?
Yes.
Okay, got it. And I just missed on the land, the capex side, you mentioned 160 crores is total land cost, out of which you paid 70, so 90 is remaining.
Yes. 90 we paid already in April.
Okay, you already paid in April. So this 90 is over and above this 700 crore capex guidance project plus maintenance.
Yes.
Okay. That's all from my side. Thank you.
Thank you.
Thank you. We have our next question from the line of Sonal Gupta from HSBC Asset Management. Please go ahead.
Hi, good morning, sir, and thanks for taking my question. Just a couple of questions. One is, sorry, I missed what is the net debt now?
Close to 1,000 crores, if I remember correctly. Yeah.
1,000 crores. 1,070. And sorry, on the again on the capex, what was the capex in FY23? Because I think the press release is not very clear.
Yeah, so total is, if you see that it's showing something like 900 odd, but that also includes 200 crore of capex roughly relating to this 70 odd crore for land bank, around 60-70 odd crore, another for this asset which has been added, which is KMA and KMM, and some lease assets which are capitalized as part of India 116. So if you see the real actual capex might be around 700 odd crores.
Right. So, I mean, if we exclude, like it separately shows the non-controlling interest in subsidiary at 115 crores. So, the plant, equipment and land would be how much?
Sorry, where are you reading this?
No, I'm just looking from the cash flow statement.
I don't have that in front of me. Do you have?
Sorry, so you're saying roughly just 700 crores is the capex, right?
Yeah, roughly 700 to 750.
700 to 750. And sorry, just going back to the revenue, right? Like because last quarter we had a double-digit decline in both two-wheeler industry volumes as well as in passenger vehicle industry volumes. And this quarter we've seen the passenger vehicles come back up. Two-wheelers, of course, still remain sluggish. But last quarter we outperformed, and this quarter we've sort of seemingly underperformed. So overall, would it be like there was some pulling forward of orders in Q3, and that's why in Q4? So is it like there has been some lead lag, and that is why it's sort of the revenue has not really reflected what the production numbers have been reported for the industry?
No, actually, I'm not sure, Sonal, from where you got this perception that we underperformed. But if you see the quarter last Q4 versus this Q4, the industry grew by only 2%, and we have grown by more than 20%. So there is a clear outperformance. So I don't know from where you are interpreting it underperformance.
No, I'm saying Q-on-Q. Basically, I was looking at it Q-on-Q. So
Q-on-Q, the industry volumes are lower overall by what 1.5-2%. So we are broadly in that range. In fact, less than that.
No, but passenger vehicles would have grown, right, by 10% or so.
Yeah, so we are seeing on an overall basis. So we don't look at what to call it, category by category, because somewhere there is addition, somewhere there might not be. But overall level, there is a clear outperformance.
Okay. Sure, sir. And just on, could you give us the... Sorry,
go ahead.
Could you give us share the sensor and controller revenues for the year?
Sensor and controller?
For sensors and controllers, generally you've given the numbers.
Okay. So sensors and controller business for FY 22-23 is overall around 450 odd crores.
450?
Yeah.
Okay, sir. Great. Thank you so much for taking the question.
Thank you.
Thank you. We have our next question from the line of Nikhil Kare from Invesco. Please go ahead.
Yeah, thank you for taking my question. So my first question was on the lighting business. So we have won a lot of LED orders, LED lighting orders over the last few years. Another aspect that I wanted to understand was what is the share of, say, headlight revenues now within the overall revenues? I understand the headlight would be the major value contributor within lighting content in a car. So what would be the share of headlight revenues?
While I don't have, Nikhil, the ready number available for headlamp, but you will be surprised to note that of late, the tail lamp revenue is more than headlamp revenue per kit.
Oh, is it? Okay. But for us, directionally, it has been improving, right? Like a lot of orders that we receive even on the headlight side. Would that understanding be correct?
No, largely, majority I would say tail lamp, because it's all LED, and where the kit value is much more than a headlamp. And headlamp also we have got some business, but yes, mostly I think majority is tilted towards the LED tail lamps.
Okay, got it. And then secondly, on just on the margin side, I understand we don't really provide segmental data on the margins, but what we've seen is that on the casting side, obviously the margins have come down with the increase in two-wheeler alloy wheel revenues, and also I think the pricing that we had on the alloy wheels, higher margins that you were talking about, those were going to go down.
Hello.
Hello.
Nikhil, I was not able to follow. There was little vibration in the voice.
Yeah, sorry. Is it better now?
Yeah, please.
Yeah. So I was saying, directionally, our margins on the casting side would have down. And then even on acoustic systems, I don't think there is been a significant improvement. Now going forward with new plants kind of coming in, and now with, I think, even the RM prices maybe stabilize, not a lot of benefits on the RM side, it would be fair to assume on the margin side you might see pressure going just because of the fact that you have so many plants that will be kind of coming in next year or so. Might take some time for the utilization level.
So, Nikhil, while your voice was still feeble, I believe you were looking at a kind of a margin guidance, if I am not wrong, right? I think as Mr. Gora has, we have been indicating that margins would be 11 to 12% in the range.
Around that. Okay, sure. Got it. Thank you. That's it from us.
Thank you. Ladies and gentlemen, in order to ensure management is able to answer queries from all participants, please restrict your questions to 2 at a time. We have a next question from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. Good morning, and thank you for the opportunity. First question is regarding the EV order book that you have now, close to 1,900 crores. Could you give some sense on the ramp-up of that in terms of revenues? How can some guidance on how those revenues could ramp up from these orders the next few years?
So, Mukesh, when we talk of the annual peak value, we are talking of annual peak value for FY24-25. Roughly, that's what the customer is indicating, and in some cases, it is 25-26 as well. So, definitely, you know that while when we say the revenues, we say based on what customer is guiding us. So, what we have started giving this time, and I'm sure you would have observed that what has been the EV volumes as a part of industry in terms of overall volume, so which has been roughly like 4.5%. And what has been our revenue in that segment, which has been roughly almost 8.5%. So that is the kind of delta we have been talking about, that we should be able to add significant value through addition of these new products, right? And that is what we are seeing. Now, in next year, as I said, you will have commissioning of the motor plant in the second quarter, and also the EV JV with the FRIWO. That plant also gets in commission in the next financial year. So with that plant commissioning, you will also see some of the businesses getting to us, because there are some businesses which are in terms of localization as well, where the customers might be either importing or so. So once that also commissions, so gradually you will see addition of revenues from those products also, which is actually in addition to what currently you are seeing. So like today, there is no production. But despite that, we are having the 8% revenue of our total two-wheeler business versus the industry volume of only 4.5. So I hope this gives you some perspective in terms of the ramp up and the delta because of addition of the EV products.
Sure. So just in continuation to that, for the motors, specifically the dealer part, any sense on the product range that we are looking at in terms of kilowatt, and what motor ratings range are we going to be manufacturing initially?
Yeah. So as of now, it's all low rated motors up to 3 kilowatt, and we are also working with our JV partner to develop the mid-range motors from 3 kilowatt to 6 kilowatt. And that is currently under the evaluation stage, and then it will get into the development stage. So that should be far. So initially it is only up to 3 kilowatts.
Right. And just last thing is the acquisition of the remaining 22% that we have done on the alloy wheels business. From when is this effective date, sir? In terms of the minority interest, how much is that getting reduced by based on when is it effective?
Yeah, so what we have done, Mukesh, is a little different what we normally would expect. So while Minda Kosei is 100% ours, the two other entities, they are going through the court merger scheme, which will take roughly a year. But what we have done is we have signed another agreement with the Kosei JV partner, where we have taken the management control of the two entities. Because one of the entity, which is Kosei Minda, is actually a loss-making entity, and obviously we wanted to act fast in terms of turning around, etc. We didn't want to waste another year and waiting for the court process to get over and then we take management control. So we have signed an agreement separately with the JV partner and taken full management control of the entity. So even though we have got a very small stake of around 18-20% in that entity, we have retained the management control so that we can take all the decisions required to sort of have a fast turnaround of that business. Yes, one can say that it will be a drag on the overall profitability in the short term. Yes, it will be. But we rest assured that we are working to see that we turn around this business in the next 12 months or so.
Okay. But the fact that we have acquired the 100% in the Minda Kosei business, that would have resulted in the reduced minority interest, sir.
Yes, absolutely. That's what impact you are seeing in the current quarter also. Otherwise,
that is for what period, sir? It wouldn't be for the full quarter, I was assuming.
Okay, I believe you are asking for MK, right?
Yes.
So MK, the acquisition was completed in the last week of March only. So.
Yeah.